All right, let's dive in. Today, we're looking at a recent article from The Motley Fool, really getting into Dollar General.
That's right. Our source is this analysis from Fool.com. It breaks down their latest financial results, digs into why the stock surged,
Yeah.
and sort of looks at where they stand in the current economy.
And our mission here is pretty straightforward. Unpack the main insights from this analysis, figure out what the source actually says is driving this turnaround at Dollar General, look at the future prospects according to the article, and basically get you up to speed, quick and clear.
And, the headline itself kind of grabs you. It's Dollar General surges on a return to profit growth.
Yeah.
Is this recession-proof stock still a buy?
Right. That definitely signals something big happened.
Yeah, sets the stage, performance, stock price, the whole deal.
Okay, so let's unpack that surge right away. The source really highlights the big news. Dollar General stock jumping, 16% on June 3rd alone.
The huge one-day jump.
Yep.
And that was right after their fiscal Q1 earnings report dropped.
And the article points out it wasn't just that one day. The stock's actually been, surging is the right word, up about 50% over just the last few months.
Those are really eye-catching numbers. And the article ties this directly to those Q1 results. That's for the period ending May 2nd.
So what did those results show?
Well, first off, comparable store sales grew 2.4%. And just a reminder, comps, that's sales at stores open at least a year. So it gives you a better feel for the underlying trend.
Got it. Better than just overall growth and overall revenue.
That was solid, too, up 5.3% compared to last year, hitting $10.4 billion.
And the article noted something interesting there, right?
Yeah, it actually beat what analysts were expecting. The consensus was slightly lower, around $10.3 billion. So a slight beat on the top line.
Okay, but here's where it gets, really interesting and maybe the core reason for that stock jump.
Exactly. The return to profit growth, earnings per share EPS that increased 8% to $1.78.
Which was way above expectations.
Way above. Analysts were thinking more like $1.49. So a significant beat on the bottom line. That always gets attention.
And the article digs into why that profit bounced back.
It does. It points to improved margins as a key factor. Gross margin specifically increased by 78 basis points. It landed at 31.0%.
Okay, 78 basis points, that's 0.78%.
Okay.
Sounds small, but in retail, that can be significant.
Absolutely. And the reasons the source gives for that improvement. Two main things. Lower shrink.
Shrink, meaning theft, damage, inventory loss.
Exactly. Less inventory vanishing for various reasons. And also higher inventory markups. So they're getting a bit more for what they sell and losing less of it. Both help the margin.
Makes sense. But there's always the expense side, too.
Right, and the article covers that. Selling, general, and administrative costs, SG&A, they did rise by 77 basis points, actually.
So almost exactly offsetting the gross margin gain.
Pretty much canceled it out at the operating level, yeah. SG&A reached 25.4% of sales. The source blames higher labor costs, incentive compensation, and also more spending on repairs and maintenance.
Okay, so costs are up, but there was another positive point mentioned.
Yes, inventory management. The article highlights that inventory levels were actually brought down. They were lowered by 7% compared to the end of the same quarter last year.
Down to $6.6 billion. That suggests, better control, less cash tied up in stock.
Yeah, generally seen as a positive sign. Better management, more efficient operations.
So, okay, we've got the numbers. Revenue beat, big EPS beat, better gross margins from lower shrink, even with higher expenses. What does the article say is the driver behind all this? What's causing the turnaround?
The source points pretty directly, actually, to the company's own strategy, specifically this back-to-basics turnaround plan they've been implementing.
Okay. So it's not just luck or the economy carrying them. They're actively doing things.
That's the argument in the article. It connects the execution of this plan to the growth we just talked about, the comps improvement, the gross margin lift, and ultimately the operating profit growth. It suggests the strategy is, really starting to work.
And you mentioned lower shrink helping margins. Is that part of back to basics?
Yes, definitely. The article flags the effort to reduce shrink, especially theft, as one specific initiative that's feeding into this optimism about the turnaround.
And this is interesting. The source connects lower shrink to employee turnover.
It does. It mentions that lower employee turnover is seen by management as a potential tailwind, a positive force helping them out.
How so?
Well, the implication, presumably, is that having more experienced, stable staff helps. Maybe they're better at spotting theft, maybe processes run smoother, less disruption.
Okay, that makes sense. So internal strategy is key. But what about the bigger picture, the economy?
Right. The source definitely brings that into it. It talks about Dollar General's history, how they tend to do well when the economy is tough or uncertain.
They even gave that example from the financial crisis, didn't they?
Yeah, 2008 and 2009. The company reported comps growth around 9% each year, right when things were really bad elsewhere. It's sort of their counter-cyclical appeal.
And the dynamic there, as the article explains it, it's not just their usual customers spending more.
No, a big part of it, historically and apparently now, is higher income shoppers trading down. They start looking for value, shift some spending to places like Dollar General.
And the source said management actually confirmed this was happening now.
Yep. On the Q1 earnings call, they specifically mentioned seeing more activity from those higher income customers, described it as the highest level in 4 years, actually.
Wow, highest in 4 years. That's significant.
It is. And interestingly, the source contrasted that with data about their core customers. About 25% of those core shoppers reported having less income than a year ago.
So their traditional base is feeling the pinch, but they're gaining these new higher income folks.
Exactly. And the article notes that management is very focused on trying to keep these new shoppers coming back. They see it as a real opportunity, not just a temporary thing.
And the source tied this into the current climate, mentioned trade wars.
It did, yeah. It explicitly mentioned the economic turmoil from the trade war as part of the current context that's helping Dollar General get back on a growth path. So blending that external factor with the internal strategy execution.
So looking forward then, what did the article say about their outlook, management guidance?
Well, despite acknowledging uncertainty, things like potential tariffs impacting the business and maybe consumer behavior management, actually raised their full-year guidance.
Oh, really? They're feeling more optimistic.
Seems so. For the full fiscal year, they bumped up their comparable store sales growth forecast. It's now expected to be between 1.5% and 2.5%.
And that was up from?
Previously 1.2% to 2.2%. So a decent little raise there.
And what about the bottom line, the EPS forecast?
That got nudged up slightly too, mostly at the low end. The previous range was $5.10 to $5.80. The new forecast is $5.20 to $5.80. So tightening the range upwards a bit.
Okay. And long term, does the article see continued growth potential?
Yeah, it suggests they'll stick to their established playbook. Keep opening new stores.
They open a lot of stores.
They do. And also refreshing existing ones. They mentioned projects called Elevate and Renovate. That usually means updating the look, the layout, maybe the product mix, just improving the shopping experience.
So basically, keep doing what they've done successfully for years. Just blanket the country with these convenient discount stores.
Pretty much sums up the strategy outline.
Yeah.
Which brings us back to that headline question.
Right. After this big stock surge, does the source think Dollar General is still a buy?
Well, the article's conclusion is a bit nuanced. It definitely acknowledges the stock isn't as cheap as it was a few months back. That 50% run-up changed the valuation picture.
Oh.
But it argues the company is still, well-positioned if economic volatility continues. They benefit from that uncertainty.
And it sounds like the article gives credit to the back-to-basics plan.
Yes, it suggests the strategy really seems to be working, judging by these latest results. That improvement is seen as a positive sign.
A sign of things turning around for real.
That's the implication. The article feels this recent recovery bodes well for the company's long-term health.
And it put the current price in context, too, didn't it?
Yeah, it made the point that even after the surge, the stock is still trading way down, like over 50% below its all-time high. So depending on your perspective.
It might still look appealing compared to its peak.
Right. So ultimately, the article wraps up its analysis by saying Dollar General appears to be a good bet over the coming years.
And we should stress, as always, that's the specific view, the conclusion from this one Motley Fool article we've been digging into today.
Absolutely. It's one analysis based on the recent data points and the company's own narrative about its strategy.
Okay. So just to kind of pull back from this deep dive, what we've seen from the Motley Fool article is this picture of Dollar General's recent strong performance. It seems driven by, a mix of things.
Yeah, executing those internal plans back to basics, tackling shrink, but also getting a boost from the economy, pushing some higher income shoppers their way.
Right. And the outlook, based on the guidance cited in the source, suggests they expect to keep focusing on growth, sticking to their expansion plans.
It's definitely a story of a company trying to fix its own operations, while also maybe riding a wave of shifting consumer habits due to the economic climate.
So maybe something for you to think about after hearing all this. Consider how these big economic shifts, like potential tariffs or just general uncertainty that the source mentioned, how they can really change the game for consumer behavior right across different income levels.
Yeah, it's fascinating.
And then think about how companies, using Dollar General from this deep dive as an example, have historically managed to adapt or sometimes even benefit when people start changing how and where they spend their money on a large scale.